In this video we are going to talk about the magic of the dividend snowball. So before starting this video, please like this video and subscribe to this channel for our future updates. When a snowball is thrown at the proper time and in the right place, it may perform astonishing feats of magic. The simple act of starting tiny and allowing it to flourish on its own has an infinite number of consequences. The analogy of the snowball is ideal for describing compound interest. You stand at the top of the hill and let your snowball roll down the mountain. It starts out little, but as it gains momentum and more snow, it grows in size exponentially more quickly. The greater the height of the hill, the greater the size of the snowball at the bottom of it. The concept of compound interest is precisely the same as this. As an illustration, if you save/invest £1,000 and earn a 4% return on your investment, you will have £1,040 at the end of the year. If you don't add anything further to your pot during the course of the year, you'll receive that 4% on £1,040 the following year. You'd therefore have £1,081.60 at the end of the year, and so on and so forth. The annual increases are minimal, but they mount up over time since they are compounded. The genius of compound interest, or the impact of a magic snowball, is that it works both ways. Compound interest is interest paid on money that has already been earned as interest, such as savings or investments. This cycle leads to increased interest and account balances at an increasing rate, sometimes termed as exponential growth. The notion is referred to as the snowball effect because it occurs when a little snowball rapidly grows in size as it rolls down a hill, accumulating snow along the way. However, while rolling downhill, the snowball does not just grow in size at a constant pace, rather, it accelerates its mass increase. Due to the fact that as the ball grows in size, the more snow it gains with each revolution, because the snow it gained on its previous revolution is now contacting the ground and picking up snow in addition to the snow already on the ball, the more snow it gains with each revolution. This, we feel, may be applied to high-quality dividend growth stocks, such as the Dividend Aristocrats and Dividend Kings, which have increased their dividends for 25 or more consecutive years, respectively, and have increased their dividends for 50 or more consecutive years. Through the use of outstanding enterprises, this essay demonstrates how to harness the power of the snowball effect to increase your wealth and income many times over. An example in the real world. Compound interest is without a doubt the most potent wealth-creating machine on the face of the planet. In fact, Albert Einstein is said to have referred to it as the eighth wonder of the world at one point. As an example, suppose you lend $100 at a rate of 5% interest compounded annually. This is an excellent illustration of the concept. If you invested $100 in year 1, you would gain a 5% return on your investment, leaving you with $105 at the beginning of year 2. On the other hand, in year 2, we are earning 5% on the sum of $105, which means that we would earn a total of $5.25 in interest for the year. For example, in year 3, we would earn 5% on $110.25, resulting in interest of $5.5125, and so on and so forth. Over the course of 20 years, your $100 will have risen to $265.33 in value. Instead of compounding, it would have just paid a steady $5 per year, resulting in a total return of $200 on your initial investment. Compounding has the potential to produce great returns, as demonstrated in this example, where returns increased by 65.3% over a 20-year period due to compounding. The snowball effect and its application. Now that you've seen how effective it can be at increasing returns, how can you put the snowball effect to work for you in your investments and make the magic of compounding work for you? We don't have to look much further than Warren Buffett and his colleague Charlie Munger, who are widely considered to be the greatest investors in history. All there is to investing is picking excellent stocks at good times and sticking with them as long as they continue to be good companies, says Warren Buffett. It may seem obvious, but this seemingly common-sense statement actually contains 3 profound principles that are essential to successful investing. 1. Identifying long-term compounders. 2. Locking in favorable compounding rates. And 3. Exercising patience to allow the snowball effect to work in your favor. While it is more difficult to identify long-term compounders than it is to identify short-term compounders, they always share the characteristics of producing high returns on equity, while also possessing strong and durable competitive advantages that allow them to maintain their high returns on equity for extended periods of time. What is it about these two characteristics that makes them so important? Among the points made by Charlene Munger in the following quotes are the following. In the long run, return on equity is critical since it is the single most essential element in deciding how much money you will earn as a return on your investment. On a long-term basis, it is difficult for a stock to generate a significantly higher return than the business that underpins it generates. If a corporation returns 6% on capital over the course of 40 years and you hold on to it for the entire period, you will not gain much more than a 6% return even if you get it at a significant discount at the time of acquisition. In contrast, if a corporation makes 18% on its capital over a period of 20 or 30 years, even if you pay an exorbitant price, you will end up with a fantastic outcome. In the event that equities lose their competitive advantages, and hence their capacity to compound equity at attractive rates, you may find yourself trading in and out of them on a regular basis, denying yourself the full benefits of compounding. If you're going to buy something that compounds at 15% per year for 30 years and you pay 135% tax at the end, the way the math works out is that you'll keep 13.3% per year after taxes after all of the taxes are taken out. To put it another way, if you purchased the same investment, but were required to pay taxes on every year's earnings of 15% out of the 15% that you received, then your return would be 15% minus 35% of 15%, or only 9.75% per year compounded. As a result, the difference is greater than 3.5%. In addition, the impact of 3.5% on the numbers over long holding periods, such as 30 years, is genuinely eye-opening. Examples of the snowball effect. In the financial world, dividend growth companies are defined as stocks that have the long-term competitive advantages that allow them to compound their equity at high rates of return over lengthy periods of time. These are equities that have a history of not only providing investors with additional cash flow year after year, but also of increasing the amount of cash flow sent to investors year after year. This has the effect of creating a double compounding effect, which results in an exponentially expanding stream of dividend payments for shareholders. In this scenario, the investor's yield on cost, i.e., the amount of dividends received in relation to the amount of money initially invested in each share, increases year after year, which, as we will see in the following examples, leads to some spectacular wealth-building results over a long period of time. Coca-Cola, KO, one of the world's largest beverage firms, is a classic example of a long-term compounder with long-lasting competitive advantages, which has resulted in exponential returns for investors who have held on for the long haul. It owns or licenses more than 500 non-alcoholic brands that are all distinctive. Since its foundation in 1886, the company has expanded to more than 200 countries across the world, with its brands accounting for around 2 billion servings of beverages per day throughout the world, generating approximately $35 billion in yearly revenues. In part, this is due to the company's powerful name brand and delicious-tasting drinks, which have earned it a fiercely loyal following among consumers, allowing it to charge higher prices and compound investor equity at double-digit rates over an extended period of time. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.